Welcome back to Wealth and Mobility Insights, the podcast brought to you by Gallant and Tool, where we don't just follow the rules of global finance, we help rewrite them for those playing at the highest levels. I'm your host, Sarah, and whether you're a family office principal or a founder navigating cross border capital, this show is your edge. At Gallant and Tool, we engineer autonomy across borders. We help our clients stay strategically invisible where they need to be and fully forfeited where they must be seen. But today, we're shifting the focus to something that might change the way you think about building real wealth. Here's the hard truth: the people who build generational wealth, they're not waiting around for deals to become public. They're already in. And to unpack what that really means and how you can step into that inner circle, I am joined by someone who is in those rooms every day. Alban Jerome, Senior Partner at Gallant and Tool. Welcome back, Alban.
Thanks, Sarah. Always good to be here.
So, Alban, let's set the tone. We're not just talking about vague investing theory today. We're breaking down the actual strategies that get elite investors and founders into a high value deal before they hit the public radar. For anyone who's wondering how certain people always seem to be early, what's really going on behind the scenes?
Well, honestly, great question to start off the conversation. And it's honestly something that we get asked all the time. Now, the biggest mistake for most investors is waiting for deals to become visible. By the time a company hits public markets or even late stage private rounds like, say, Series D or Series E, the asymmetric upside is already priced in. So the real wealth building potential, that's in the earlier stages, right? Before the enter the market, off market opportunities. The ones that are being discussed in private syndicates, between family offices, or within tighter investor networks. A lot of investors assume access comes down to luck, being at the right event, knowing the right people, getting that golden invite. But in reality, it is much more strategic. Access comes from intentional positioning. It's about structuring your personal and your business ecosystem that when the right deal hits the circulations, when you become aware of it, you are ready to act. This means having flexible capital, the right legal structures, a very tax efficient setup, and relationships that consistently surface these vetted deal flow to you. You don't want to hope to stumble into opportunities, right? You want to engineer access to them.
So, Alban, let's unpack that a little bit. When you say someone needs an opportunity, what does that really mean in practice?
So, being opportunity ready means more than just having interest or ambition in deals. It's about having the right infrastructure, both on a personal and a corporate level. So, actually, be ready to move when the opportunity arises, right? Not 3 months later when it's gone out of the price you want, it's overpriced. So there are four key elements that I would like to break this down into, right? Global mobility and capital freedom. So you need to be able to move your capital across borders quickly and legally without getting tangled in red tape. That means setting up international banking structures, second residencies, or even offshore entities. Again, not to evade taxes, but to ensure that you have the flexibility to act fast when a cross-border or a global opportunity appears. If you're stuck in a single jurisdiction, with a rigid financial system, you're going to miss out. The second thing is to have a private deal access infrastructure built in. Now, this is a huge step. You can't just sit back and wait for the pitch deck to fall into your inbox. It's not Willy Wonka's golden ticket. You had to build these real relationships with family offices and angel syndicates. Talk to VC scouts, early stage funds, and secondary brokers. That doesn't mean just following and connecting with people on LinkedIn and hoping for a newsletter or maybe a once-off message. It means showing up in their circles, adding value, co-investing, making referrals, right? You got to feed that network. You need to be in the rooms where pre-market conversations are happening, and that takes intentional effort. Then is liquidity planning. This is where a lot of people trip up, right? They see this great deal, but they can't participate because their wealth is already tied up in real estate, long-term funds, or tax inefficient vehicles. Opportunity ready means having smart, flexible liquidity, capital that you can quickly deploy and strategically, ideally through the right tax optimized structures, right? This is something we actually help a lot of investors engineer early so that when the deal appears, they're not scrambling for it. And then, of course, reputational capital. And this is really the invisible currency in our business. The more people see you as a smart, strategic, and value adding investor, the more likely they're trying to bring you into these great opportunities when they are being created. You have to build this up by building up on relationships, making very smart bets, sharing insights with your peers, and of course, being someone who others want to add to their cap table. So when I say opportunity ready, I don't just mean having the money for it, but also having the mobility, the networks, liquidity, and the reputation to play early in deals that never hit the public radar till it's ready for retail market. And that is where the real leverage lives.
Switch tracks for a minute. You mentioned family offices and syndicates earlier. Those high trust, high capital environments where a lot of pre market deals live. But let's be real, most founders aren't in those rooms by default. So, how do they actually get in if they're not already part of that inner circle?
Oh, that's a big question. And you're right, those rooms are not always invisible and they're almost never open in mind. But the good news is, it's not about having $1 billion fund or a last name that'll get you into the door. It's about being proactive in the ecosystem, building strategic value in a way that attracts inclusion rather than asking for permission. Now, at Gallant and Tool, we actually walk founders through very three practical strategies for this. And the reason we know this works, it's pretty much what we do every day, right? Like this is our butter and bread. So at Gallant and Tool, we are in these rooms, first of all, structuring the deals, navigating compliances and engineering outcomes across border. So we're not really making guesses, we're actually the ones executing stuff. So when we advise some of our most agile, capital savvy founders, we first tell them start by referring value. Before you ask to sit at the table, start sending value to the table. That might mean forwarding an interesting deal you've vetted, introducing a great operator, sharing intel on a vertical you know very well, whether it is a lead that is generous for someone to close on or a strategic alignment, right? When you become a consistent source of insight or opportunity, people naturally will start bringing you into more conversations because your opinion matters. Your information and wisdom is important. Second thing, align yourself strategically. Don't just turn up there as an investor with a big checkbook and say, I'm ready to check. Show up some post deal firepower. Founders are always looking for investors who can bring operational insights, global scale experiences, or exit discipline, and they're very, very valuable to early stage investors and syndicates. If you can accelerate a portfolio's company path to profitability or traction, or just avoid costly mistakes, that's a huge edge. Position yourself always as a strategic partner, not as another cap table name. Third, use advisory as a leverage. Now, most people think of advisory as back office stuff, but smart investors use modular advisory. They play fractional CFOs, tax experts, fund restructuring. That's one way. Or technical experts or market operators. You can show up in a deal both with capital and a vetted world class advisory framework behind you. And at that time, you're not just investing, you're de risking the deal for everybody involved. That makes you an asset, not just an investor. And the bottom line is this: access is always learned through alignment. If you build trust, show up with value, and make other people feel smarter, richer, and faster in the market, you'll get invited into the right rooms no matter where you start off.
Okay, but let's talk about the founders who are still in the trenches, building, fundraising, and scaling. And just to be clear, this isn't just for the founders with deep pockets. Some of the most impactful early investors we see are the ones who started with no spare cash, right? Just operational insight and the willingness to show up early. You don't need millions, you need a plan, a framework, and the right positioning, of course.
Absolutely. In fact, some of the smartest plays I've seen didn't come from founders with deep pockets. They came from founders who were resourceful with your expertise, their network, their time, and strategic positioning. Because here's the honest truth, right? It's not always about cash. It does help, but there are really incredible ways that where you can build your startup from being a cash strapped entity to real great success, right? And these are three effective pathways that we've seen in if you are very capital constrained. One is sweat equity. Many emerging startups, especially in frontier markets or specialized tech verticals, need experienced operators more than you need another passive investor, which is true. So a great example is think about all the early engineers who joined OpenAI or Stripe in their infancy, right? They did way below their market comp because they wanted equity. That is known as sweat equity. Trading your operational expertise, your labor for a real ownership stake. Even at an advisory level, this works. Take someone like Balaji Srinivasan. He's taken advisory positions in dozens of pre-IPO companies, offering technical insights or connections in exchange for early equity rather than cash. That model works if you're a CTO, a marketing expert, or a cross-border strategist. Then you have something known as SPV participation at minimum buy-in. Founders often assume you need $500,000 to get into early stage deals, or you need someone with deep pockets. But that's not true, right? Special purpose vehicles are actually designed for this. It makes platforms like AngelList, Better Ventures, or even invite only syndicates run by family offices are now actually building their own SVPs where a minimum check size of 5,000 to 25,000 can get you in. One example is the rolling fund model pioneered by AngelList, where smaller investors can pool in resources to back a fund, especially run by a manager that they trust. In, I think, 2021, about 400 new SVPs were supposed to be created on AngelList alone, which is a huge thing because now there's such a low barrier to enter. So if you got the conviction and the right syndicate you're able to pick, you can get access to deals and funding that was reserved only from institutions in the past. Now, the other thing that we tell them is advisory for equity roles. Founders are such a unique position because they understand execution risk in a way most investors will not. So this makes them insights incredibly valuable to each other, especially other early stage startups, especially in emerging tech, where you're pretty much building the economy and the technology as well as a startup all in parallel, right? An example of this that I would think top of my head is Jason Calanes, who didn't just invest early in companies like Robinhood and Uber. He also advised and amplified them early on. So most founders don't realize they can do the same thing on a smaller scale when they're advising their fellow startups, or they're going to help each other on go-to-market strategies or operations or funding prep, right? And you can do it for a small equity, from something like say 0.5% to say 2%. So if you're a founder who's still in the building phase, don't disqualify yourself, right? You have so many different opportunities that's available, and especially don't undervalue yourself because you have to learn to leverage your network, your knowledge, and your ability to create value. And that makes it your entry ticket to this world. The where information travels fast and trust is scarce, being seen as a strategic contributor, not just a capital provider, brings value to you, right? And this gets you to more deals and opens up more opportunities for yourselves to get people onto you. So be selective, stay aligned with your long term thesis, whether it's raising capital or investing capital, and most importantly, show up early and show up strong for people you're supporting.
Quick pause. If this is hitting home and you're starting to think differently about your role as a founder and investor, take a second and visit galto.com. We're not just talking about theory, we're helping investors and family offices every day to restructure their holdings, unlock capital flexibility, and get invited into the rooms where the best deals happen. If you're building something serious, we should talk. Let's zoom out for a second now. You've made a strong case for early access and opportunity readiness, but why does this matter so much right now, especially in today's market?
Well, because Sarah, the fact is the landscape has changed dramatically and drastically, right? Public markets are no longer where innovation starts. That's where it ends up, often years after real value has been created and captured. We're seeing this across sectors: AI, biotech, energy, fintech. Most transformative companies are generating 10 or even 100x returns before they ever file an S1. Take OpenAI, for example. By the time the world really understands its value, pre IPO equity had already moved through hands of many insiders, early institutional bankers, and family offices. The same thing has happened to Nvidia's rise, right? When you look at the numbers, where upstream private investments in AI infrastructure and related startups have yielded exponential returns for investors before the retail investors even realized what the brand was capable of. So the public market, it's not the starting line anymore. It is the scoreboard. And if you're waiting for CNBC or Bloomberg to confirm this is the new trend you should invest in, well, you're already late. Now, add another layer to the new world, right? We're operating in a climate of unprecedented volatility across markets, currencies, geopolitics, regulations. Oh my God, the world's changing every half an hour, right? We've got global interest rate instability. Currencies are getting fragmented. Accelerating cross-border capital restrictions are like happening around weekly basis. Regulatory clampdowns are happening before you realize what's happening. And a lot of people look at that as noise, but the fact is it is a signal. In this environment, agility and early access become non-negotiable. A really smart founder or investor is one who's positioned to raise or deploy capital early and who can move across jurisdictions very effectively. They are the ones who will thrive in uncertainty. And here is the core idea. Founders can no longer just be operators. You have to become strategic capitalists, which means thinking like an investor while you're building your own startup, understanding deal dynamics, capital flow, cultivating relationships that will open doors for you when you're ready for them, right? These are private opportunities which you have to earn your way into. And make sure you're building your infrastructures to act on them, right? Whether this is across borders, currencies, timelines, because the next decade of wealth capital isn't about building your company alone. It is participating in the growth of others if the rest of the world catches on. And that is something I feel a lot of people are not yet caught on.
That phrase, strategic capitalist, I love that. It really captures the mindset shift that you're actually describing. So let's land the plane here. Can you leave us with a few concrete actions the founders can take today to start positioning themselves?
Absolutely. Now, if you're a founder listening and you're ready to stop watching opportunities from the sidelines, here's a quick but powerful playbook you can start implementing. Number one, map your ecosystem. Paper pen, grab or an Excel sheet, all right? Open one and list everyone in your network who touches capital, deal flow, emerging infrastructures, industries, right? Whether this is VCs, family offices, angel investors, operator turn investors, think of anyone who handles capital. Then ask, who am I constantly in conversation with? Who do I bring value to? Who brings value to me? If your answers are thin, that's a signal, right? It's time to build those bridges intentionally. It takes a while, so you need to start early. Second, set up intelligent liquidity. Plan having planning having capital is one thing, but being able to deploy that strategically, quickly, and tax efficiently is a whole different beast. So talk to your advisors, talk to your accountants about creating flexible opportunities for you. This means rebranding or repositioning a portfolio. Create opportunities for yourselves by using debt. Find a way to restructure maybe some of your existing portfolio into more efficient vehicles. Now, if you get capital locked in illiquid real estate or long term equity, or you're somehow stuck in a highly taxed jurisdiction, you're not opportunity ready, you're kind of boxed in, right? And that's a good structure should give you optionality, and optionality is power. Third, join or create a founder syndicate. The fact of the matter is, you don't need to write $1 million checks or earn $1 million checks at once. In fact, one of the smartest things you can do is to invest with others. Syndicates actually let you allow to do this, right? Share deal flow, pool capital together, pool resources together, access better terms, conduct group diligence, lower your personal risk. Platforms like Angel List or Spearhead are great for this. Or go grassroots level. That's what I did a few years ago, right? Grab 3, 4 founders, build a circle, start a small quarterly investment roundtable. It doesn't have to be fancy. It just has to be consistent. Fourth one, engage with a fractional advisory layer. The right advisors are not just going to back office functionality that you need to put in. They're actually a deal access engine. So when you work with fractional CFOs or global strategists or growth oriented legal partners, you're not gaining technical skills alone. You're actually gaining a lot of intelligence about the market, referral opportunities, and building credibility. Matter of fact, at Gal2, we actually bring founders into opportunities they would never see otherwise because they're part of a trusted advisory ecosystem that's designed to surface early stage deals and support the decision making behind them. Fifth one, which I say all the time, stay curious, right? Stay early. Skip the mega conference where everybody's already pitching and posturing. Instead, go to a private pitch event. Attend demo days from accelerators you respect. Join founder only forums or dinners. Volunteer as a mentor. Work with incubators in industry. The goal is to be in a room before the deal goes mainstream. And that's where asymmetric returns are born. And most importantly, be the person who adds value in those rooms. That's how you get invited back. And if you do these 5 things intentionally, consistently, you're not just preparing to invest. You're actually building a foundation to operate as I say a strategic capitalist, one who sees where opportunities where others don't, who's able to move earlier than the crowd and can create wealth by design, not by accident.
That's it for today's episode of Wealth and Mobility Insights. A big thanks to Alban Jerome of Gallant and Tool for breaking down what it truly means to think and act like a strategic capitalist. If you've got value from this conversation, and I know you did, share it with a founder in your circle who needs to hear this. And while you're at it, leave us a review, subscribe, and follow us on your favorite podcast platform. It helps more ambitious leaders like you discover this show. If you've been waiting for the sign to start playing in the private market space, this is it. Every week you wait, deals close, valuations move, access tightens. Go to galto.com right now and take the first step to becoming the kind of wealth founder who doesn't just build wealth, they multiply it. The entire system is in place, the access exists. All that's missing is your decision to act. Until next time, be early, be strategic, and keep building forward. Thank you.